Hello and welcome to Portfolio Matters. In today's episode, we will be doing a short piece on leveraged ETFs and how they can work if an index is going steadily upwards, but they're very dangerous in drawdowns. And if there's a big drawdown, then there's the potential they will wipe out all your capital. Okay, so leveraged ETFs, and you see a lot of these. And we will soon show you the performance of the 3 times leveraged NASDAQ ETF, which has been absolutely extraordinary. But by their nature, they exaggerate volatility. And if an index rises on low volatility, they can work very well. And they can do pretty much what they are designed to do, which is giving you leverage return of the index. However, if there's a big drawdown, they don't work. And actually, you can end up losing a lot of money, even if the index goes up strongly. Okay, and the easiest way to see this is to look at the maths of a 30% drawdown. So in this small table here, we have simulated the effect of a 30% fall in the index and then a recovery back to its prior level. So the index starts at 100, falls to 70, and then recovers to 100. So you have an initial fall of 30%, then you have a 43% recovery return to get back to 100. Now, the 3 times leveraged ETF will fall 90% in the drawdown and then recover by 130%. But the trouble is that 90% drop will have taken the NAV from 100 to 10. And then the 128% return from 10 only gets you to 22.9. So, although the index has been volatile but has gone nowhere, your 3 times leveraged ETF has lost almost 80% of its value. So drawdowns are extraordinarily bad for highly leveraged ETFs. And if there's no volatility, they work very well. So this is a simulated effect of an index that just rises steadily every day. And you'll see the leveraged ETF works fine. Now this simulates the effect of an index that falls to 99, then recovers to 100 every day. And you'll see the 3 times leveraged ETF just steadily loses value. So an index that's going nowhere and just has a bit of volatility, the 3 times leveraged ETF will steadily lose value. And if you change the volatility to 5% drawdowns and recovery, then the effect becomes much more stark. And this simulates the 30% crash and recovery. You'll see the orange line. At the end of the period, you are back to 100. The 3 times leveraged ETF, you've lost almost 80% of your money. And this just gives the maths behind that last chart if you are interested. Now, this is interesting because the NASDAQ 3 times leveraged ETF has done absolutely extraordinarily well. So there's been very little volatility actually in the NASDAQ over recent years. So in the period since the bottom of the COVID recession, and that's dangerous. Do not be beguiled by the very strong performance, and be aware that if there is a drawdown, 3 times leveraged ETFs are very dangerous. Richard, your thoughts?
Yeah, it's interesting, Keith. I mean, they're very alluring, aren't they? 3 times ETFs. You think something is a dead cert. So, and you've got, say you've got £1,000 to invest. You think something is a dead cert. You see a 3 times ETF. You think, oh well, I can invest I can get £3,000 worth of returns. But you can also wipe yourself out very, very easily. And they only really work as the graph where you just had the sequential 1% drops and then back up again. They only really work if the market is continually rising.
Yeah.
And as soon as the market starts to fall, then your losses are geared. They are. I don't think they're a long-term investment at all. They're a short-term. If you have a strong feeling about something, then you might buy it for a few days or a week, but you shouldn't hold them for a prolonged period of time, unless you're very sure of what you think is going to happen. And I don't know what that chart of the 3 times ETF for the Nasdaq. If you bought it in one of those rather acute spikes down, you would have had to have held it through a really unpleasant trough in order to gain the ultimate benefit of holding it all the way up to the maximum gain. And many people would not be able to do that either. So it's a very useful warning, Keith.
Yeah. Okay. Thank you all for watching. I hope you'll press like and subscribe to the channel. And in the meantime, it's goodbye from Richard Wheater.
And it's goodbye for Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.